A lot of pensioners still think savings interest stays private until they tell HMRC. That is no longer a safe way to think about it. In many cases, your bank or building society already sends interest details through the system, and when that interest pushes you over the limit, the tax problem can arrive long before the warning makes sense. If you want plain English updates before small money issues turn into expensive surprises, subscribe now. This channel is built for people who want to stay one step ahead of letters, rule changes, and quiet tax traps. That way, when something changes, you hear it early enough to do something about it. Now let's calm this down and get to the truth. This is not about HMRC secretly staring at your savings account every day. It is about data, reporting, and tax rules that more pensioners are falling into because savings rates went up while tax limits did not move much. So for many older people, the rule feels new, even when the system itself is not. Here is the simple version. If your money sits in an ordinary savings account and it earns interest, that interest can count as taxable income. Not always, and not for everyone, but it can. And once your total income and savings interest go above certain limits, HMRC may want tax on the extra amount. The reason this is catching more people now is easy to miss. A few years ago, some savings accounts paid so little interest that many pensioners never got close to the limit. Now, even a careful saver with no fancy investments can earn much more interest from a normal bank account or fixed-rate bond. That one change has pulled a lot more retired people into HMRC's view. Think about someone with a state pension, a small private pension, and a decent emergency fund. They may not feel rich. They may still watch every bill, count every shop, and worry about winter costs. But if those savings start earning stronger interest, the tax system may suddenly treat them very differently from how they were treated before. And this is where the real confusion starts. Many pensioners hear the words tax-free allowance and assume all their savings interest is covered. It is not that simple. There are different allowances. They work together, and what you get depends on your other income. That is why two people with the same savings can end up with different tax results. Tell me in the comments if this has happened in your home. Did your savings interest stay tiny for years, then suddenly jump enough to make you wonder about tax? A lot of people are only noticing this now, and your experience may help someone else spot it early. First, there is your main personal allowance. Right now, that is the amount of income you can usually have before paying income tax, and for most people that figure is £12,570. If your wages, pensions, or other income do not use all of that allowance, any spare part can help cover savings interest too. So not every pensioner with interest owes tax. Then there is something many people have never heard explained properly. It is called the starting rate for savings. In simple words, if your other income is low, you may be able to earn up to £5,000 in savings interest at a 0% tax rate, but that extra help shrinks as your other income rises above your personal allowance. Here is the easy way to picture it. Once your non-savings income goes above £12,570, each extra pound starts eating into that £5,000 savings starting rate. If your other income reaches £17,570 or more, that starting rate is gone. This matters for pensioners with modest income because some of them still qualify and do not realize it. After that comes the Personal Savings Allowance. This is the part most people have heard about, but often only half understand. If you are a basic rate taxpayer, you can usually earn up to £1,000 of savings interest tax-free. If you are a higher rate taxpayer, that drops to £500, and additional rate taxpayers get no personal savings allowance at all. So let's make that real. If your pension income uses up your personal allowance, but you are still in the basic rate band, you may still have that extra £1,000 savings cushion. That means the first £1,000 of taxable savings interest may be tax-free. But if your interest goes above that, the extra part can be taxed at your normal rate. That is the bit many people never budget for. Now, here is the part most people miss. These allowances can stack in some cases. A lower income pensioner may use some personal allowance, then still benefit from some starting rate for savings, and then still have the personal savings allowance on top. That can mean a surprisingly large amount of interest with no tax at all, but only if their other income is low enough. Let's use a simple example. Imagine a pensioner whose total pension income is £11,500 a year and whose savings earn interest. Because their other income is below the personal allowance, some of that allowance is still unused. They may also still qualify for some or all of the starting rate for savings. That person could be in a much safer position than they think. Now compare that with someone else. They get the state pension and a private pension that together take them well above £12,570. They also keep £30,000 or £40,000 in ordinary savings because they want safety and quick access. At today's interest rates, that savings pot can produce enough interest to use up the personal savings allowance faster than expected. That is where the tax bite begins. If someone in your family still says, "It's only savings, HMRC won't care," share this with them. That old thinking can cost real money now. A quiet little account is not invisible just because it feels boring. Sometimes the boring accounts are exactly where the surprise comes from. There is another key rule you need to know. If your savings are inside a cash ISA, the interest is normally tax-free. That interest does not count toward your savings interest allowance in the same way as ordinary taxable accounts. So two pensioners with the same amount saved can get completely different outcomes depending on where the money sits. The account wrapper matters just as much as the interest rate. That is why people get caught by chasing the best rate without checking the tax position. A normal savings account may advertise a strong return. A fixed bond may look even better. But if the money is outside an ISA, that interest may be fully visible for tax purposes. A good rate can still become a bad deal if the tax shock wipes out part of the gain. Pay close attention to this next detail. HMRC does not rely only on people volunteering this information out of kindness. Banks and building societies in the UK report interest information to HMRC as part of the system. That information helps HMRC build tax records, check returns, and in many cases adjust tax codes. So the idea that no one will notice is simply not a safe plan. And this is where the title of this video starts to make sense. When people say HMRC is watching your savings, what they really mean is this: the system is better connected than many pensioners realize. Interest paid by banks can feed into HMRC's records, and once it does, the tax question is no longer just between you and your passbook. It becomes part of your wider income picture. If you are employed or you receive a pension through PAYE, HMRC may try to collect any tax due by changing your tax code. That means the money is often not taken straight from the savings account itself. Instead, the system may reduce the amount you receive from wages or pension payments. For many older people, that is why the problem feels confusing. The account looked fine, but the pension payment changed. HMRC can estimate your savings interest for the current year by looking at what you earned the previous year. So if your interest rose sharply once, the system may assume something similar will happen again. That can lead to a tax code change that feels strange or too high. Sometimes it is right, sometimes it needs checking. If you are not working, do not receive a pension through PAYE, and do not normally file a self-assessment tax return, HMRC may contact you another way if tax is due. You might get a calculation or a letter telling you what they think you owe. This is why opening post from HMRC matters, even when it looks dull. A lot of expensive mistakes start with an envelope people leave on the side for later. Now here is the timing point that really matters. The tax year runs from April 6th to April 5th. Banks report the interest, HMRC processes data, and letters or coding changes can follow later. So the problem often shows up after the money has already been spent, moved, or forgotten about. That delay is exactly why some pensioners feel ambushed. Have you ever had a tax code change and thought, where on earth did that come from? If you have, say yes in the comments. You are not alone, and it often makes more sense once you trace the interest from your savings back through the tax year. There is also a rule many people do not hear until they are already behind. If you go over your savings allowance and do not get the expected contact from HMRC by the end of the following March, you may still need to get in touch yourself. In simple words, silence is not always safety. If you know the interest went over the limit, waiting forever can make things worse, not better. And if you already complete self-assessment, the savings interest usually needs to be reported there. That includes many people with side income, rental income, or more complex finances. Also, if your income from savings and investments is over £10,000, that can trigger the need to look at self-assessment more closely. This is where many people get caught out because they think pensions and savings are too simple to need a tax return. There is one more important point, and this can save people money. If too much tax was taken from your savings interest or from your wider tax position because of that interest, you may be able to reclaim it. There is a time limit for claiming back overpaid tax, and it does not stay open forever. So if you think the figures were wrong in a previous year, do not assume it is too late without checking. Many pensioners make the same first mistake. They think state pension is free money and not really part of taxable income. But the state pension is taxable income, even though tax is not usually taken off it before you receive it. So when you add state pension, a private pension, and savings interest together, your tax position can change much faster than expected. That single misunderstanding causes a lot of confusion. The second mistake is assuming retirement means savings interest is automatically tax-free. Retired does not mean outside the tax system. What matters is your total income, your tax band, and where the savings are held. A pensioner with modest pensions and big savings can still face tax on interest, while someone with lower income and the same bank account might not. Status alone does not decide it. The third mistake is believing that moving money between accounts hides the trail. It does not. If the money keeps earning taxable interest outside tax-free wrappers, the tax question still exists. Changing banks may help you get a better rate, but it does not make the interest disappear. The focus should be on understanding the tax position, not outrunning it. Here is another detail that changes everything for some couples. With a joint account, the interest is usually treated as split equally between both account holders. So if a husband and wife share an account, the tax effect may also be shared. That can help in some cases and complicate things in others. The important point is this: the name on the account matters. Now imagine one partner has very little income and the other already pays more tax. A joint account may spread the interest 50-50 by default, which can be useful. But if the real ownership is different or the arrangement is more complex, the tax treatment may need proper checking. This is not an area to guess your way through. Small paperwork details can change the result. Pause for a second and think about your own savings. Are they sitting in one easy access account, several saver accounts, or a fixed bond you hardly think about? That quick check matters more than most people realize. Sometimes the interest is spread across accounts and feels harmless, but the total across the year is what tells the real story. Now let's talk about why even ordinary savings pots can create a problem. If you are a basic rate taxpayer, your personal savings allowance is usually £1,000. That sounds generous until you do the maths. At 4% interest, £25,000 of taxable savings can produce £1,000 in interest. At 5%, even £20,000 can get very close. That means a pensioner does not need massive wealth to cross the line. A careful saver who sold a car, inherited a small sum, downsized, or kept money back for care costs can easily hold that much in cash. And if the interest sits outside an ISA, the tax system may notice before the saver does. That is why this issue feels so personal right now. For higher rate taxpayers, the squeeze is even tighter. Their personal savings allowance usually falls to £500, so a smaller amount of interest can create tax. Some older people move into that band not because they feel wealthy, but because private pension income, part-time work or other income pushes them over the line. The allowance shrinks, but their habits may not change with it. But that is not the full story. Some pensioners are still protected more than they think. If your other income is low enough, that starting rate for savings can be very valuable. So the danger is not only overpaying tax, it is also underclaiming your own allowances because nobody explained them clearly in the first place. If this video is helping you untangle a rule that always felt muddled, subscribe and keep following. These are the updates that sound small until they hit a pension payment, a benefit review, or a bank balance. And once that happens, everyone wishes they had understood it earlier. So what should you do now? Start with the basics and keep it simple. Check how much interest each taxable savings account paid you in the last tax year. Do not guess from the current balance. Use annual statements, bank summaries, or the figures shown in your online account. Next, separate ISA savings from non-ISA savings. That one step alone removes a huge amount of confusion. Cash ISA interest is generally tax-free. Ordinary savings accounts, fixed-rate bonds, many building society accounts, and similar products outside an ISA can all count toward taxable savings interest. You need to know which is which before you total anything. Then look at your other income. That means state pension, workplace or private pensions, part-time earnings, rental income, or anything else that counts. Once you know that number, you can begin to see which allowances may still apply to you. This is where many people stop too early. They check the interest, but forget that tax is decided by the full picture. After that, check whether HMRC has changed your tax code. If your pension income suddenly looks lower, or your tax code letter shows an adjustment you do not understand, do not shrug and carry on. Read it closely. The reason may be savings interest from the previous year, and if the estimate looks wrong, that is the moment to challenge it, not months later. Keep your paperwork together. Tax code notices, P60s, pension statements, annual bank interest summaries, and any HMRC letters should live in one place. That way, if you need to question a figure, you are not trying to rebuild a whole year from memory. Older viewers tell me all the time that stress drops the moment the paperwork is organized. They are right. Now here is a smart planning point. If you are still saving money each year and you have ISA room available, it may be worth checking whether some cash should sit inside a tax-free wrapper instead of an ordinary savings account. That does not mean rushing into anything. It means understanding that rate is not the only number that matters. Sometimes the better after-tax result comes from the slightly less obvious option. Another thing to remember is that tax on savings and benefit rules are not the same subject. Some viewers mix them together because both involve money in the bank. Savings interest tax is one issue. Capital rules for means-tested benefits like pension credit or council tax reduction are a separate issue. Do not assume that solving one automatically solves the other. And please be alert to scams because this topic attracts them. When people hear HMRC and tax owed, panic makes them vulnerable. Scammers know that. They send texts, emails, and phone calls claiming urgent savings tax problems and demanding immediate payment. A real tax issue should never push you into rushing money to a stranger. If you know an older parent, a widow, a carer, or a neighbor with savings outside an ISA, send this to them. They may be one letter away from a nasty surprise and not even realize it. Sometimes sharing clear information is worth more than sharing money. It gives people time to act before the problem grows. So let's bring this home. HMRC is not peeking through your curtains. But the system does receive savings interest information from banks and building societies, and that means ordinary pensioners can no longer assume small-looking savings are invisible. The real risk is not having savings. The real risk is not understanding how the interest changes your tax position. What matters most is simple. Know what type of account your money is in. Know roughly how much interest it has earned across the tax year. Know how that interest sits beside your state pension and any other income. And if a letter, code change, or refund issue appears, deal with it early. Because once you understand the rules, the fear starts to go. You stop guessing, you stop assuming, and you start making decisions before HMRC makes them for you. That is a much safer place to be, especially when every pound matters. Subscribe if you want more straight, calm updates like this without the jargon. And share this with anyone who still believes savings interest is too small for HMRC to notice. For a growing number of pensioners, that old belief is exactly what causes the problem. Stay informed, stay organized, and stay ahead of the next letter.